Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to be talking about how to structure Freddie Mac Home Possible first-time home buyer loans. Give us just a moment here to go live on all the different platforms. Appreciate everybody tuning in nice and early. We got the chat up on the screen there. Feel free to drop a comment there in the chat. All right. Okay. It looks like we're live on all the different platforms, so we'll go ahead and get it started here. We'll take the chat off the screen for now, but keep dropping comments in there, drop any questions you have in there as well. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender that specializes in non-QM loans. And what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern is our Loan Officer Training Series, where we do a pretty in-depth training into a different topic. Today's topic is going to be how to structure Freddie Mac Home Possible first-time home buyer loan. So kind of a mouthful there, but Jose will go ahead and break it down for us. So I'll let you go ahead and get into it here, Jose.
Good evening, everybody. Thank you for joining us for tonight's training on how to structure a Freddie Mac Home Possible loan. Now, Freddie Mac and Fannie Mae are the two agency providers that make up our conventional loans, right? They all have their different set of underwriting guidelines. So, you're going to see a lot of similarities in tonight's presentation compared to last night's Home Ready loan, which was the Fannie Mae affordable option. The Home Possible is the Freddie Mac affordable option, and I will point out the differences to you throughout the presentation so you can be aware. Now, I will state, though, as I like to state in all the trainings we give when we discuss, for example, income, self-employed borrower income specifically, there's a couple of good reasons why you would use Freddie Mac as an option instead of Fannie Mae, right? And that's going to follow then. One is going to be the Home Ready option, the other is going to be the Home Possible option. Main reason we're looking at here benefits for Freddie Mac over Fannie Mae. Freddie Mac has their verbiage in their findings on Loan Prospector, where if the borrower has been self employed for at least 5 years, then you can provide only 1 year's tax returns for the business and for the borrower instead of two. That's a big plus right there. That's an automatic on LP. With DU, you may or may not get that finding. Plus, also, when you are reviewing your self employed borrower income, Freddie Mac is a little easier to work with when you have borrowers, self employed borrowers that aren't necessarily declaring as much to, or in distributions as they are in ordinary income under Schedule K1. That may bring you some issues that may be easier to overcome in the Freddie Mac loan if your borrower can show liquidity. And then there is how Freddie Mac treats student loans, right? I believe Fannie Mae is 1% of the total balance for the monthly payment, whereas Freddie Mac is half a percent, 0.5% of the total balance as the monthly payment on those deferred student loans. That's 100% difference in a monthly payment. And some of these students have $50,000, $60,000 or more in deferred student loans, or the borrowers, should I state. And that could be the difference between a $600 payment, for example, and a $300 payment on their liabilities. So let's get into it now and break it down on what is a Freddie Mac Home Possible loan. Well, again, it is a conventional loan, but Freddie Mac likes to state it this way, that offers underwriting flexibilities to qualified borrowers who meet specific income criteria, very similar to Fannie. Now, it is an affordable lending program, very common to be used by first time home buyers. However, this is a big however, it is not restricted only to first time home buyers because they actually do allow you to own another property while you own the subject that you're buying. Um, it has lower interest than traditional 3% down conventional first time home buyer option. And it also offers reduced mortgage insurance, 25% coverage instead of the traditional 35% coverage for a 3% down first time home buyer. That's not an affordable option. So, who qualifies for the Home Possible loan? The same scenario for Fannie is applicable for Freddie. Borrowers that are at 80% or less than the area median income, also known as the AMI, for that census tract, unless the property is located in a low to moderate income or a minority census tract. And that information will be um, available when you, for example, here I have the link to the Freddie Mac eligibility, AMI eligibility. That's a tongue twister. Lookup tool. And then you click on there, it takes you to the website, you put in the address of the property, it takes you to the census tract, and it lets you know what 80% is of the AMI for that census tract, and also lets you know if it's in a target zone for low to moderate income or minority. That's really important. Again, this loan is open to all U.S. citizens, permanent residents, and non-permanent resident aliens. Non-permanent resident alien does not have a green card, does not have permanent status here to live here in the U.S., but does have a work authorization document of some sort. They are legally allowed to work here in the U.S. They are legally working here in the U.S., and then they would be able to qualify for the loan just like any other borrower by providing the necessary income documentation and having the necessary credit in here, U.S. based credit and U.S. based credit scores. Home Possible loans do allow manufactured homes up to 95% LTV. There is no restriction like with Fannie Mae. The Home Ready option stated that you needed to meet the requirements of the MH Advantage, Manufactured Home Advantage program, which requires a manufactured home to be much newer than 1976, which is as far back as we can go for any manufactured home loan. So the Home Possible loan, then I would say, is more favorable for a manufactured home if you're getting a pre 1990 manufactured home, 1976 to 1990, because you're not going to meet the MH Advantage requirements. So you'd be going Home Possible if you wanted to take advantage of the conventional affordable loan program. Primary residences only, of course, because this is a subsidized program. And then I do have there in bold the minimum credit score is determined by LP, aka Loan Prospector. That's the Fannie Mae automated underwriting engine. Freddie Mac. Sorry, Freddie Mac is Loan Prospector. Fannie Mae is desktop underwriting. So LP, that's why we're talking about Home Possible. But I do note there, you'll see in red bold, uh, the matrix, right, which would be for the theoretical manually underwritten file, right? The matrix states minimum of 660 for a 1 unit and minimum of 700 for a 2 to 4 unit, whereas Home Ready had a little bit easier credit. So the algorithm in Home Ready is probably a little bit easier, more forgiving, should I say, than the algorithm is on credit for Loan Prospector, because Home Ready had 620 in that theoretical manual underwritten loan in their matrix, 620, and Freddie has 660. So again, got to look at the algorithm. Purchase and rate and term refis only, and like I mentioned, borrowers may have up to 2 finance properties, including the subject. So They can have a property that's their exit property, right? And they're going to buy another property now. You know how that goes. Bigger property is going to be their primary, closer to work, whatever it is that makes sense for their getting this second um, primary. Now, this new property is going to be their primary. They have their exiting property. Uh, this affordable option loan does allow that, right? So that is a very good feature. That's why I stated not only is it not for first time home buyers only, it is not for only home buyers. You can have another home. Now let's get into the transaction details. Very pretty much identical to the home ready option. We're looking at our maximum 97% LTV, right? That's for not for manufactured home. That's why it's up. It's the manufactured home is 95, up to 105% CLTV when combined with a community second. And again, details on the community seconds vary. There is no set community second, so it does allow it, but Freddie's not offering the community second. They just allow you to combine it. Arms are restricted to 5, 7, and 10-year arms only. And note that if it's a manufactured homes, they do not qualify for the 5-year arm. Max LTV of 95% if there is a non-occupant co-borrower. And here's an interesting note. If it's a 1-unit property purchase, there's a 0% minimum contribution from the borrower's personal funds if gift or grant funds are used to meet the minimum 3% borrower contribution. So minimum down payment, we're 97% max LTV, let's put it that way, which means you got to come up with 3% from somewhere. But if it's a 1-unit property, they don't require it to be straight out from the borrower. If you can get the gift or the grant for that amount of money, good to go. No minimum borrower contribution in that respect of borrower's own funds. That's a big plus right there. If it's a 2 to 4 unit property, again, minimum 3% contribution from borrower's personal funds. Home buyer education is required when the borrower is a first-time home buyer. Again, since this is not a program just restricted to first-time home buyers, right? It's an affordable program, but if they are first-time home buyer, then they have to do the first-time home buyer education. And again, gift grants and community seconds are allowed, and up to 3% interested party contribution as well. So if you got that gift or grant and your community second, you can still get 3% seller contribution to help with the closing costs, which is a pretty good feature. So let's highlight our program benefits here. Reserve requirements, again, as always, when we have AUS, will be determined by LP. The minimum credit score will be determined by LP. What do I mean by that? What I mean is there is no minimum credit score requirement. Realistically, if you're going through AUS, if the system doesn't like it, it doesn't like it. You could have a 685 and not get the accept that you're looking for because there could be other high risk factors in the loan that LP doesn't like. Right, so that's why when we use an automated underwriting, we really can't say there's a minimum score. I did give you that 660 figure to use as a benchmark to have an idea that if your borrower is less than 660, that it may not give you the approved eligible. So keep an eye out for that and other possible options. We did discuss the reduced MI factor of 25% coverage on 97% LTV instead of the 35% coverage that is the requirement for traditional 97% first-time homebuyer options. The spread between the two options, and this was for a $485,000 loan on a $500,000 purchase. The difference between one and the other, between MI on the regular product and MI on the affordable product, is what, about $35 more or less but that's free money. That's just for the program, reduced MI. On top of that, reduced rates. It's about 0.25% lower rate for the Home Possible versus the regular 3% down option. So lower MI, additional savings on the rate because we do have our affordable options. And again, similar to the Home Ready loan, we do have some pretty innovative and flexible underwriting that allows us, amongst other things, like emphasizing this one here, the use of income from a rental unit, such as an ADU or a 2 to 4 unit property, but the ADU is the big part right there, and the use of border income. And I will break it down in the next slide because that's really, I know, pique your interest right there, because we got many people that have an ADU or they have a border and they haven't really been claiming it on their tax returns, right? There's no Schedule E to show that, but we do have ways around that, which I'll show you in a minute. And then we can have non-occupant borrowers or co-borrowers, such as the parents, for example. And I did mention the no minimum contribution from borrowers' own funds on 1 unit properties. Another big one here, cash on hand can be used with restrictions, which I'm going to break down in the next slide as well, because that's another big one. And sweat equity. Sweat equity can be used when working with an approved eligible program provider. Because if it's sweat equity, it usually means that you have some type of a renovation loan or a construction loan, either or, and you're doing some of the work yourself. Um, that's being managed, and that's why we're talking about with an approved eligible program provider. That's agreed that you're going to do X amount of work, and when X amount of work is done in a workman like manner, and with this program they do require a 442 final inspection to show that the work was completed, then you can get credit for your equity to go towards your transaction expenses, like your down payment. So that's really, really important. Now let's break down the border income and cash on hand usage, because there are some differences, a little bit of difference between the Home Ready and Home Possible option. So both feel the same way, that the border, both allow up to 30% of the total income, borrower income, can come from this border or rental income. Now, it can be used if the border is not obligated on the mortgage loan and does not have an ownership interest in the property, nor is the borrower's spouse nor domestic partner. That's important to note. Excuse me. The borrower must have lived with the borrower, in the property for the last 12 months. The borrower can provide appropriate documentation to demonstrate a history of shared residency, right? That they've lived there, right? So their driver's license show that it was issued, during the period of the rental, a billing, and other stuff to show the address of the subject property. We want to be able to show that they lived there. And then here is where it's a little bit different. In the Fannie Mae option, it talked about the border providing canceled checks to show that they actually, or transfers to show that they actually made the payments. In this case, it asks the borrower to demonstrate receipt of rental payments, and this would be like your bank statement showing the deposits, the deposited item, Venmo transfers, stuff like that, for the last 12 months, or at least 9 of the most recent 12 months, provided rental income is averaged over 12 months. So that part doesn't change. But in this case, they're asking the borrower to demonstrate the receipt of the rental payments versus the borrower to provide verification of making the payments, like canceled checks or the transfers. A little bit different. And then the cash on hand is a little bit different here. First, you still got to show that the borrower is a cash basis individual and the cash is not borrowed and could have been saved by the borrower. But here's where it gets a little bit different in the details. At least this is straight out of the Freddie Mac Home Possible guidelines. It requires copies of 6 months of cash receipts or the proof of the transfer made, like through Venmo, Cash App, to verify that recurring obligations are customarily paid in cash. So yeah, you got your FPL receipts for the last 6 months that you paid in cash, your cell phone receipts for the last 6 months you paid in cash, or whatever it is that you're paying in cash. They're going to give you a receipt, copies of 6 months cash receipts. Um, the funds must be in a bank or an escrow account prior to closing. Home Ready said at least 30 days prior to closing. So that's a difference right there. Here's just prior to closing. Saying we want a letter of explanation from the borrower disclosing the source of the funds and that they are not borrowed. And now here, this next one, specific here in the Freddie guidelines, whereas in the Fannie was a little bit more vague. Here they state that the credit report obtained at loan application must not show more than 3 trade lines. Right. On the Fannie, it's just said like you can't really have an extensive credit history and relationships already established with financial institutions and have them think that you're just dealing on a cash basis. Well, here they're telling you straight out if the credit report has more than 3 trade lines, then just you can't, that borrower cannot be considered a cash basis borrower. And last but not least, this one is one of like they really want to make sure that the borrower, if he does have credit cards, that the borrower did not get cash advances from the credit cards because cash advances are not acceptable forms of unsecured debt for your source of funds. So definitely no cash advances. So they want copies of the last 3 months of statements of all open revolving accounts, credit card accounts, to confirm that cash advances are not the source of borrower funds. So if you have 3 revolving accounts, give the last 3 months statements of all those 3 accounts, and they're going to review them. And if they see any cash advances in there, you're going to have to show that that cash advance isn't any of the cash that you actually have right in there in the account or that you have available. So that's going to maybe a tough one to convince the underwriter on that. So that's basically how it works with the Home Possible loan, right? So the main takeaway that one of the main takeaways, I guess, here on the Home Possible, so that you don't lose any potential Home Possible opportunities, is note that this is not a program for first-time home buyers. This is an affordable based program. You have to go to the website, the link, the AMI lookup tool, look up the address of the property and see what the income is. See if your borrower is at 80% or less, or if it's maybe a low to moderate income census tract or minority census tract. So then there is no income limitation in that case for a borrower to take advantage of the program in that area because they want to create more economic activity for those areas. So do not leave any money on the table. Either way, if you have a deal that could be potentially qualify for one of these and you did not select the affordable option when you're running AUS, it will prompt you to tell you, hey, your borrower's income is at or below 80% of the AMI for that area, and they could qualify for the Home Possible if you're running LP or Home Ready if you're running DU.
Okay. Thank you, Jose. Looks like we got a couple questions here. Let's pull the first one up on the screen there. Question is, do we work with any community second companies?
That would be more of do the investors, our investors work, allow us to include any community seconds in the loans. So you would really, that's going to be investor specific. So you would have to review the guidelines to see which investors allow it, which don't, because even though the guidelines allow it, then that's where the overlays come in. So not all the investors allow it. Some do. and then you'd have to find out which are the community seconds that they allow to be worked with. That's how that process works.
All right. And then another question here. If a borrower qualifies for both Home Possible and first time home buyer, which would you recommend?
Well, I think I showed that breakdown in one of the slides where I showed that on a comparable $500,000 transaction, both at 97% loan to value, same borrower. The only difference is one was priced with the traditional 3% first time home buyer option and the traditional mortgage insurance. The other one was priced with the affordable home possible option and the affordable option for the MI requiring only 25% coverage instead of 35% coverage, right? And the difference was that the affordable MI was about $35 cheaper per month, and the affordable product had an interest rate about 0.25% lower. So, based on the data, I think the answer is the home possible or home ready option would be always the preferred option. That because in essence it is an affordable option, right? That's why they call it. That's the purpose of the loan, and it's always going to have lower costs associated with lower monthly payment on the MI and lower monthly payment due to the lower interest rate for the similar cost.
Okay. I don't see any other questions, so I think we can wrap it up. Remember, we do this every Tuesday, Wednesday, and now Thursdays at 7 p.m. Eastern Time. So we appreciate everybody tuning in. We will see you next Tuesday, 7 p.m. Eastern, for the next episode of the Loan Officer Training Series with the Mortgage